Have you ever wondered what actually happens after a company makes a huge purchase? Like a massive, brand new piece of factory equipment? Well, that purchase kicks off this really fascinating journey in the world of accounting. And today, we're going to follow that journey, right from day one all the way to how it looks on the company's official financial reports.
So let's picture it. Your company just dropped some serious cash on a big, shiny, expensive new machine. It's an exciting time, but for the accountants, well, their work is just getting started. So what does happen now? How do you take this big purchase and record it in a way that tells the true financial story of the business?
Okay, first things first. We got to speak the right language. In accounting, this new machine isn't just a thing or a purchase. It has a special name. It's called a fixed asset. So what exactly does that mean?
The official fancy term is property, plant, and equipment, or just PP&E for short. And the key things to remember are right here. It's got to be tangible, something you can physically touch, and it has to be a long-term player. It's something the business is going to use for more than 1 year to help generate revenue. So why all the special treatment? It really boils down to one of the most important ideas in accounting, the matching principle. Think of it like this. That machine is going to help you make money for years, right? So it just wouldn't make sense to record its entire cost as a massive expense in just 1 month. The goal is to spread out that cost over its entire working life, matching the expense to the revenue it helps bring in.
All right, so we know what it is and why we treat it differently. Now for the really practical part. How do we actually get this machine into the company's official records, or what we call the books?
And here is where a lot of people get tripped up. The cost of the asset isn't just the price on the invoice. Nope. In accounting, the true cost includes every single penny you had to spend to get that asset up and running and ready to do its job.
Our machine is the perfect example. Let's break it down. We start with the purchase price $50,000, but you can't use it yet, right? It's still at the manufacturer, so we had to pay $2,000 just to ship it to our factory. And then we paid a technician another $1,000 to install it and make sure it's working perfectly. All of those costs were totally necessary.
So you add all that up and boom, $53,000. That is the number that matters. This is its capitalized cost, the official value that we're going to record on the books.
And this right here is how we make it official, with something called a journal entry. Now, don't let the words debit and credit scare you. All we're doing is this. We're increasing our machinery account by $53,000. And to pay for it, we're decreasing our cash account by the exact same amount. See? It balances perfectly. The asset is now officially on our books.
Okay, our machine is on the books. Job done, right? Not even close. The asset's journey is really just beginning, because an asset that's going to last for years doesn't just sit there at its original price tag. We have to account for the fact that we're using it year after year.
And that brings us to a really, really important question. We know this machine is going to last for, let's say, 10 years. So how do we show on paper that a little piece of its value is being used up each of those 10 years? How do we follow through on that matching principle we talked about?
The answer is a word you've probably heard before: depreciation. Now, listen closely because this is the most misunderstood concept. Depreciation has absolutely nothing to do with what the machine is actually worth if you tried to sell it. It is purely an accounting process. It's just a systematic way to spread that initial $53,000 cost over all the years we expect to use it. It's the expense of using the asset. Now, the most popular way to calculate this is called the straight line method, and it's popular because it's beautifully simple. You just take the initial cost, you subtract what you think you can sell it for at the very end of its life, we call that the residual value, and then you just divide that number by how many years you plan to use it. So let's plug in the numbers for our machine. We know the cost is $53,000. Let's make an educated guess that in 10 years, we could probably sell it for scrap metal for about $3,000. That's our residual value. And we've estimated its useful life to our business is going to be 10 years.
Okay, time for some quick math. $53,000 minus that $3,000 residual value leaves us with $50,000. You divide that by 10 years, and what do you get? $5,000. That is our annual depreciation expense. Every single year for a decade, the company will record a $5,000 expense just for using this machine. And you know the drill. Every transaction needs a journal entry. So each year, we debit or increase our depreciation expense account by $5,000. And then we credit this really interesting new account called accumulated depreciation.
The best way to think about this account is like a running total, kind of like a piggy bank that just keeps track of how much of the asset's cost we've expensed so far. And this account is going to be super important in just a second.
All right, we've recorded the cost, we've figured out the annual expense. Now it's time for the final piece of the puzzle. How does all of this actually look to the outside world, to an investor or a banker who's reading the company's financial statements? Let's see it in action.
So, if you're looking for our machine on the balance sheet, which is that snapshot of what a company owns and owes, you're not going to find it mixed in with the short-term stuff like cash. Instead, you'll look under a section called non-current assets. That's the signal that this is a resource that's built to last. And here it is, the grand finale. This is how our machine appears on the balance sheet after 1 full year of use. Notice how it's presented. First, we always show the original historical cost, that $53,000. Then, right underneath, we subtract that accumulated depreciation account we just talked about, which is $5,000 after year 1. And what's left is what we call the net book value. That, right there, is the value of the asset on the company's books.
So, let's just do a quick recap of the assets journey. We started by identifying it as a fixed asset, a long-term resource. We calculated its true initial cost, which included everything to get it ready. Then, we used depreciation to systematically spread that cost over its useful life. And finally, we saw how the balance sheet tells this whole story, original cost minus all the depreciation so far.